Hi, this is Mike Larson for Money and Markets TV. Stocks have been showing signs of strength recently, so it's no surprise that the same people who hyped the market and the economy the past 2 years are back at it again. In the summer of 2009, they said a short-term pullback was just a correction. And thanks to $800 billion plus in economic stimulus spending and the Federal Reserve's asset-inflating program of quantitative easing, they were proven right. Then last summer, they said the flash crash and market pullback wouldn't amount to anything. And because helicopter Ben Bernanke launched QE2, they got that right too. But folks, this summer it truly is different. Multiple central bank policymakers have said they won't support a QE3 program, so the Fed can't ride to the rescue again. Congress and the Obama administration can't help much either. They're too focused on tax increases and program cuts to launch any significant new stimulus programs. And even the bailout brigades in Europe are running out of power to spike the markets with more monetary booze. Not even 1 week after Eurozone policymakers managed to cram a Greek austerity package down that country's throat, bonds in all the pigs nations have started melting down again. The bottom line, nobody is riding to Wall Street's rescue this summer. So unlike in 2009 and 2010, a lasting rally just isn't in the cards. In Washington, the great debt debate is coming down to the wire. Treasury Secretary Timothy Geithner has said Republican and Democrat lawmakers have until August 2nd to reach a deal. But it takes time to draft legislation that authorizes any increase in the debt ceiling, so the real deadline is more like late July. Moreover, any legislation will contain some combination of spending cuts and tax increases, an anti-stimulus package, if you will. In fact, I expect we'll get at least twice as much anti-stimulus as the $1 trillion we got in stimulus 2 years ago. For this reason and more, it's important to shut out the siren song of Wall Street pundits. They pointed to a recent improvement in manufacturing data as evidence that the economy is rebounding, and that sent the Dow Industrial sharply higher. But they ignored the fact that most of the strength in that survey came from inventory building. That means manufacturers are stuffing the wholesale and retail channels in anticipation of a rise in final sales. But the latest consumer confidence and spending figures tell us that no such rise is coming. So the factories are going to be forced to power back down, an extremely bearish development for the economy. Meanwhile, the University of Michigan's confidence index fell by nearly 3 points last month, a bigger drop than expected. Construction spending tanked by 0.6% in May, its sixth straight monthly decline, and far worse than economists predicted. And the ISM Services Sector Index sank to its second lowest reading this year in June. And finally, what about jobs? Well, we had another anemic month with only 18,000 non-farm payrolls added in June. May's job growth was revised all the way down to 25,000. And the unemployment rate rose to its highest level since December, 9.2%. As if that weren't enough, outplacement firm Challenger Gray & Christmas said layoff announcements rose more than 12% between May and June. Look, I'd love to tell you that the economy is in good shape, that the sovereign debt crisis is solved, and that we're in for a rip-roaring rally, just like what we saw in 2009 and 2010. But rather than a summer of market love, I believe we're in for a summer of discontent. And that's why I continue to urge you to take profits off the table and hedge against a market decline using things like inverse ETFs. I'm Mike Larson for Money and Markets TV. Thanks for watching.